Cool. All right, good evening. David, I'm just going to give it a couple more seconds just to allow people to stream in.
Yep.
But while we're doing so, I'll just have our general disclaimer slide up. It's always nice to start with a disclaimer. By the way, will you have your video on today, David?
Did you want me to put it on?
Yeah.
Sure. One sec.
Nice, nice, nice. All right, well, let's just kick things off anyway, but do it really slowly. As I always do, I'm gonna run over the points of the disclaimer. So this forum is strictly for Smartkarma subscribers. Yep. It's purely for informational purposes. It's not really investment advice. It's the opinion of our inside providers and not of us guys. And obviously Chatham House rules apply, which means please don't share any of this on social media or any other medium for that matter without express permission from us. Look, with that in mind, I'm just going to very, very briefly recap some of the things we talked about in the last few forums. And before I do that, I do want to introduce David Blennerhassett to you. He's dialing in from Hong Kong. He's one of our senior analysts and one of the founding members of the Smartkarma research platform. Hello, David.
Hello.
Cool. All right, let's kick off with the recap. So last week, as is typical with these forums, we tend to look at three things: a small cap, a large cap, and a theme. Last week, we took a look at CPMC, which is a very unique company that gives you exposure to Chinese consumption, but at much lower valuations. We also looked at an emerging space, which is the China property management services, about $50 billion of market cap now. And we also spoke about the emerging thesis around Chinese banks. The week prior, we were looking at a China communication construction, a stock that has that's really, really beaten down, but it has all the ingredients to turn around this year. We spoke about PC Partners, which has had a great run this week, actually. And we also looked deeper into our thesis around liquidity. This is Michael Howell's work and how this portends a rather difficult second half of 2021 and so forth. I'm not going to go through all of these, but you get the idea. It's sort of three things every week: open mic, rapid fire, keep it nice and easy, and then you've got the platform and research to refer to later on. So what do we have this week? The three topics we're looking at, but not in this order. There's a bit of a surprise. So the first is we're going to discuss a REIT that's down 83%. Second, and the reason why David's with me today, is we're going to talk very briefly about virtual IPOs, direct listings, and SPACs, but in an Asian context. Extremely topical at the moment, and David's done a whole bunch of work here. And the third thing on the sort of thematic side, we're going to talk a little bit more about the resumption of inflation and what does that mean in terms of where people are positioned and so forth. So, as I mentioned, today's presentations are not going to be in this order. We're going to kick off with virtual IPOs, listings, and SPACs. Okay, so first things first, we will not talk about what a SPAC is today, really. For that, you can refer to the work that David's done on the platform. Also, you should read the research that David published around virtual IPOs and direct listings and how they lead to better price discovery. And most recently, some work that David's done specifically around Singapore as a venue for SPAC listings. Okay, let's get down to the discussion part, David. So first things, there's a lot of craziness and euphoria around SPACs, especially in the US market. This whole space, is there any valid objective reason to it, or is it just sheer market madness?
Oh, I think there's valid reasons for it. I think there is probably basis in some people feel that the IPO process is flawed when they sort of leave money on the table and expecting a spike on the first day, or how perhaps when it comes to IPO placements, that there's a clique of perhaps best clients for the financial advisors. I think some of those things have probably validity, but I guess when you look at things such as the rise of SPACs and how they then marry with electric vehicles, like we're seeing in something like the US recently, it's an interesting marriage. I would probably, maybe I tilt a little bit more old school. That I still feel that this is probably borderline sort of, maybe a little bit sort of spivvy in some parts, but I mean, I think there is a method to the madness. How about that?
Yep.
So,
no, I think it's good to contextualize these things and sort of know where we're sitting, in the fear versus euphoria curve. So one of the main benefits of these three things, virtual IPOs, direct listings, or SPACs, is potentially removing the middleman or making it easier for the companies to go public. I have a question. What do you see as the sort of maybe core differences between a direct listing versus a SPAC?
Well, a direct listing is going to already have an actual company. Okay, let's take a step back. I mean, there's not too many sort of direct listings out. Let's talk about something like in Asia. I mean, you've already got direct listings in something like New Zealand, which is done like A2 milk, for instance. But there's very few on the ground to really give you sort of validity. But it usually comes down, there's already an existing company with some historical sort of background and finances and whatever else. In fact, just to use A2 milk as an example, I mean, they go through a very similar process for their direct listing as they would for a normal IPO. It just comes down to when actually trading starts on the first day, the pricing is set by the market demand and supply. And otherwise, it really follows a very similar sort of route itself. That's probably the key thing. I mean, obviously, we know what a SPAC is. I mean, it's basically a company that raises money at IPO with no real project in mind, or should not have a project in mind if they sort of adhere to the correct sort of rules. And then obviously they got within 2 years to try and find something. But
right. So a SPAC, the sort of colloquial term is it's a blank check company. You don't know what they're going to buy.
Yeah.
But you're potentially excited about what they might buy in the future, but you don't necessarily know what it could be.
That's right. I mean, and I think that that also raised an interesting sort of problem in the sense that normally you've got two-year window in which to sort of find something or locate a certifiable sort of investment sort of project. And that means as the closer you get to that 2-year sort of time frame or end of it, then they may be forced to actually get involved in something they probably wouldn't normally get involved, which could actually, if you have these sort of like star tech companies, which seem to be a typical focus of SPACs, then there could, and with a lot more SPACs coming into listing, then they're being groomed by numerous SPACs. So that means they could be paying well over above what that particular vehicle would be worth in the first place. But that's sort of getting off track. But I mean, that's the key difference is really one's a blank check, one already has an existing sort of entity under its wing.
Yeah. Now let's bring it home closer to Asia, right? So you mentioned that New Zealand's had some success in direct listings, and based on the conversations I've been having, at least, they seem to have a nice pipeline of companies that want to pursue direct listings. It's a lot cheaper for them. They don't have to engage a banker the way they would if they were doing a normal IPO. And I think time to market is quicker as well. And not every company actually needs to raise money. You want to go public for various reasons, one of which could be to raise capital. So it works better. Let's talk about, the recent developments here in Singapore. You've written about this quite recently. I think it all kicked off with a BT article, but maybe just spend one quick minute on this.
Yeah, I mean, the Singapore looked at SPACs going back a decade ago and put out a consultation paper, and they went through some very detailed rationale how they may approach it. And eventually it just sort of went by because I think they didn't have confidence in the fact that the general public would really fully understand this sort of ecosystem, what's going to happen, how would it trade. They didn't feel the education was probably up to sort of scratch to actually force this particular sort of product to the market. I think what's happening with Singapore at the moment is there's a couple of things that we know that there's been a slew of delistings, which therefore there's less companies listed on the stock exchange itself. And we are seeing SPACs being listed outside of Asia in the US, some like Richard Lee's sort of SPAC. And those particular sort of SPACs are actually targeting Asian assets. Yep. So that means assets that could potentially get listed on the Singapore Stock Exchange or some other stock exchange, but let's say Singapore, they're losing out to these new fangled sort of vehicles, or a new sort of interest in these old fangled sort of vehicles. And I think it's one of those things that either if you can't beat them, you got to join them. And I think that's really where Singapore's probably coming from. And I think when I spoke to them last year, they said they might be looking to do another consultation, and then they seem to, as per the BT article and my correspondence with them, that seems to be moving forward. We don't have any sort of clear idea when this actually may take place, but given the consultation paper they've done before and how comprehensive it was, I think they could accelerate the process quite quickly.
Got it. I think there's two other developments that I think seem to be coming together all at the same time. The first is that last year has been a year of considerable success for SGX in terms of ETF listings. Yeah. They've raised, I think, significant AUM, and some of these ETFs are actually garnering decent liquidity and following in the aftermarket as well, which is positive, right? Yep. And I think the second thing is that the REIT and trust market segment has evolved to a fairly sort of heightened level of maturity. A lot of REITs now are cross-border and are listed in Singapore and decent market cap and so forth. So if you think about this, these were also structures that were not familiar to the market when they began 15 years ago.
Exactly.
And a SPAC is quite close to a trust. You got a REIT, then you got a trust, and then probably the next thing is something like a SPAC. So I think it's one step away from what's already a very decent market.
Yeah, just very quickly on the REITs too, because that was a big money spinner for the SGX, but we're also seeing a huge consolidation in the area too, which is also dwindling down the number of REITs listed on the SGX. So just
yes, I think that's a very, very good point, David. All right, David, this is the introduction we wanted for today. Thank you for participating. I know you've got to run, and I promised 10 minutes. I've gone two minutes beyond that, but look, hope to hear from you soon, and just keep writing more on this topic. It's of great interest.
Yeah, if anyone's got any questions, please feel free to hit me up too.
Bye-bye, sir.
Okay, take care.
Bye. Okay, well, that was David, dialing in from Hong Kong. And I think now I'm gonna sort of just quickly move on to the next topic for today. This is a small cap special here in Singapore. And this is a REIT called First REIT, which is down 83%, as you can see in the title. It's a stock that always used to trade between $1 and $1.20. And I think as of today, it's trading at close to 20 cents, maybe 20 and a half cents. So let's take a look at what's happened here. Okay, so first things first. This is a REIT that owns a bunch of Indonesian hospitals. So it's a healthcare REIT. And the reason it's down 83% is because of a special situation. And what is that situation? Its parent company, which is the Lippo Group, which leases these hospitals, they went through a bit of a tough patch in 2020. They had liquidity issues. People were concerned that Lippo might not be able to pay the rental that is owed to the REIT for the hospitals. And Lippo, the parent itself, went through a pretty horrific time. So if I show you a share price chart of Lippo Karawaci, which is the parent co listed in Indonesia, let's bring that up. While this loads, just let's go back here for a second while that loads. So what happened over the course of the last 12 months with Lippo is that they did a bit of a rights issue, they sold some assets, and so they fixed a lot of the problems that were going on at the parent company level. However, that did not solve the problems with the REIT here, because people still worried about what was going to happen with the rental that's owed from Lippo to the REIT. Close to the end of the year, Lipo put forward a proposal to the REIT holders. The proposal was basically, it comprised of three things. The first was, can we restructure the tenancy agreement or the master lease agreement that we have with the REIT? So can we pay you the rent a little bit differently? The second point was, if we are able to renegotiate the rental, then can we go to existing banks and refinance the debt that we owe? And third, can we raise a bit more equity? Because as you might be aware, with REITs, there are some strict covenants that you have to adhere to in terms of how much gearing you can have. So as the share price dropped, there was a fear that these covenants might be breached. Hence, raising new equity and refinancing debt was important. So in the last 2 months, so since December and into January, what's happened is all three things have been approved. So two banks, I think it's OCBC and CIMB, they've agreed to refinance the debt on the condition that the REIT does a rights issue. And also the parent company has renegotiated the tenancy agreement. And what are the terms? Very simplistically speaking, what they've agreed to is that the rent, which is divided into a fixed basic rent and a performance rent, this percentage will be changed. So it'll be slightly lower basic rent and slightly higher performance rent. But in exchange, the lease term will be extended from 7 years to 12 years. So you get an additional 5-year lease duration. Now, as a result of that, Lipo is now able to fulfill its obligations to the REIT. The banks have agreed to refinance, and the rights issue is underway. So as I speak, it's probably day 3 or 4 of the rights issues. The rights started trading on the 1st of Feb. And the rights will nearly double the amount of shares that are outstanding. What's also very, very interesting is, so share price of First REIT is about 20 cents right now, as I mentioned, and it used to trade at $1.20. So OUE, which is a sister company, also under the same group, has agreed to backstop the entire rights issue at a 20-cent price. So today you can buy First REIT at close to the price where OUE would be happy to buy the whole thing, right? So that's a soft floor to the share price in a way. Meanwhile, you're going to get a REIT that's going to give you close to 11.5% dividend yield on the basic fixed portion of the rent alone. All the performance rent would be on top. Secondly, because the number of shares on issue is doubling as a result of the rights, I think this REIT will be quite liquid. Market cap will be double of what it is today, and it'll be liquid. So, and meanwhile, the parent company shares have rallied, but the REIT itself hasn't rallied yet because of this rights issue. So it's a very, very interesting special situation. This is a Singapore listed REIT, but it has underlying exposure to Indonesia. We know that as COVID fades, hospitals are going to do better. And so you get that recovery story with a nice backstop and yield. So very, very interesting special situation. Now, just a quick mention, you can ask me questions at any time. You can use the Q&A button, you can raise your hand. I can sort of even allow you to speak if you would so like to, but do not hesitate to ask a question at any time. But if not, I'll just keep moving on. So the third and final thing for today is a brief comment about inflation. So actually the reason we've brought this up in today's forum is because it ties up very, very nicely to, the 3 themes we've been looking at. We've been looking at a turning point for banks. We've been talking about how, liquidity will spill over into economies that are going to overheat, and also what that means for financials. So inflation is sort of a common thread here. What this chart is showing, this is from the St. Louis Fed. And as you'll see right towards the end of this chart is what happened to GDP. This is in the US, obviously. So you had a very, very big spike down thanks to COVID, and now you're having a similar spike back up. Now, if you just extrapolate this line all the way up, maybe sort of well above where this image currently ends, that's where GDP growth will be by the end of 2021. So you might have seen news articles talking about, global GDP growing 8 to 10%, some countries growing more than double-digit GDP and so forth. That is true. That is indeed true. And the reason that's happening is, first of all, you have incredible base effect. Last year was just a disaster. And as economies are coming back, GDP growth is accelerating because the denominator is so low. But secondly, it's also because there is so much more liquidity now in the system. And this is happening at a time when, supply chains are disrupted. So as a result of this, you're seeing inflationary pressures everywhere, and they're not going to abate. So I'll give you an example. If you look at this news article, this is just from about 7 days ago, you had inflation numbers coming out in the EU and in Germany. And what's remarkable is that while December inflation numbers were still in the negative territory, January numbers were well above expectations. So literally no economist was even close to the inflation numbers that were reported. And this is January. January last year, COVID hadn't kicked off at all, definitely not in the Eurozone. So we're starting to see inflation come back into numbers even before the base effect of COVID sets in. Now, this is quite important. And I think when so much of the world is sitting on, negative yielding bonds and negative rates, I think even a small uptick in inflation can have a significant deviation in people's economic forecasts, growth forecasts, as well as outlook for monetary policy. Now, there's a couple of other things happening here. Tax inversion. So what we mean here is, during the Trump administration in the US, at least, we saw tax rates being cut for the rich. But I think in the Biden administration, there's talk about taxes going up, and this could potentially also lead to more inflation as corporates try and push these taxes back out to the end customer. We know supply chains remain tense. US and China relationships have not really improved. We know that there is more stimulus that's about to hit the market. Biden's $1.9 trillion fiscal stimulus is still on the cards. All of this creates a perfect year when you see inflation surprising on the upside. And this puts central banks in a real conundrum. And I think that's the biggest takeaway. Central banks are in a position then where they cannot relax anymore. They cannot keep rates where they are. The pressure on monetary policy is then towards the upside. And whether they actually act on it or whether they move away from their inflation targeting mechanism remains to be seen, but the market will start to worry about it. So as I sort of call it, the sizzle of the first half might fizzle in the second half. But in terms of positioning, right, this means GDP growth means the yield curve steepens. People start betting more and more and more and more on recovery. As that starts to happen, you need to own more and more and more financials. This is why we're talking about the Chinese banks. This is why we were talking about, developed market banks. And we continue to feel, that financials remain very interesting for that reason. Secondly, this gives a little bit of a tailwind behind commodities, with one caveat that China policy impacts commodities a lot as well. And China is a little bit confused from a policy perspective right now, or at least the market's confused about what China wants to do. But looking at global recovery, I think you see a tailwind behind commodities, both hard and soft. And also equities continue to experience a tailwind. Now, this is important. It's important to look at this last point in a little bit more detail. So the first few rate hikes are actually good for equities because they confirm that the world is recovering. However, when you're starting from zero, the first couple of hikes can really wobble the market. What does it wobble? It wobbles all the areas where there is margin in the market. What is all of that? That's all the crowded trades. So you've got to be very careful and avoid crowds insofar as markets are concerned. However, smart investing, safe investing is actually, this should be a good year because you're seeing steepening yield curves and you're seeing generally a positive tailwinds behind equities. The thing to avoid is credit sensitives, as I mentioned. You know, anywhere where there's a lot of leverage, where there's a lot of margin, whether it's pockets of the stock market or whether it's companies that are highly levered, those are the areas where I think we need to turn a bit more cautious, because the outlook for rates is going to continue to evolve over the course of the year. So that's it for today. Once again, these forums are meant to be very, very short. They're meant to be actionable. They're meant to give you ideas. And they're also meant to evaluate some of the older ideas. So if you have any questions or comments, please raise them. But if you don't have any questions today, that's fine too. You can always approach us on the platform. Okay, there are no questions coming in today, so I'm gonna say goodbye to you guys now, and we'll speak again next Thursday. Thank you very much. Bye-bye.